Welcome back to the Deep Dive. This is the show where we take really complex technical material and we turn it into clear, strategic knowledge that you can actually use in your exams. Think of it as a shortcut to being genuinely well-informed, and hopefully we'll pack in enough commercial context to make it all stick. Today, our deep dive is tailored completely for you, the serious ACCA Financial Management student. We're going to move past the simple balance sheet stuff. We're diving straight into what really makes a business tick, and that's the active strategic management of receivables and payables. These aren't just, numbers on a page. They're the twin pillars of your working capital. They represent that constant flow of cash that decides if a company is going to thrive or, if it's going to stumble. Our mission today goes way beyond just the arithmetic. We're here to really dissect the commercial logic behind it all, to expose the big financial trade-offs, and most importantly, to clarify exactly how the examiner expects you to apply your judgment. That's the highest level skill in FM, not just churning out calculations.
We're pulling all our insights directly from the FM study material covering liquidity, risk, credit policies, and the mechanics of things like factoring and settlement discounts. So if you're sitting your FM paper soon, this is where you need to pay close attention. This is where you get that critical edge. Okay, let's unpack this.
That's absolutely right. And that focus on commercial judgment, that's precisely why this topic is so fundamental to your exam. Receivables and payables management, they aren't abstract ideas. They are the actual gears driving the short-term control of a business, which is, it's intrinsically linked to its long-term viability. You should 100% anticipate scenario-based questions in the exam, questions that need proper commercial analysis and, just as importantly, well-structured written advice. These parts of the syllabus, they're so often linked with assessing liquidity and risk, which are, at the core of what a financial manager does. If we just strip away all the technical jargon for a second, we're really just talking about the speed and the control of cash. How quickly does cash come in from your customers? And just as importantly, how slowly can you let it go out to suppliers? Getting that timing right, that is what directly dictates a company's immediate financial health. It determines its ability to manage unexpected costs, to invest, to grow, or even just to survive a downturn. So let's ground this conversation in the strategic role of the financial manager. In this context, the FM's main job is to make the right financing decisions to meet the company's needs while, protecting its stability. And liquidity, the ability to pay your bills as they fall due, is paramount. There's a sort of a traditional belief that because working capital involves short-term assets, things like inventory and receivables that turn over within a year, it should be financed by short-term finance. That means using things like bank overdrafts or, and this is very relevant for us today, using the free credit that you get from your payables. This is sometimes called the matching principle.
Right, the matching principle. But, and this is a huge but, that's not the whole story, is it?
Yeah.
Especially not in a real dynamic business.
Yeah.
We have to look at the risks involved. Short-term finance, it might look cheaper on the surface. It doesn't have the fixed interest rates or the formality of a long-term loan, but it carries a massive hidden risk.
Yeah, this dual nature of short-term finance is that its flexibility is also its biggest danger. The risk is that it is often repayable.
On demand.
On demand, exactly. Think about an overdraft, the classic short-term tool. If the economy shifts, or if the bank just decides to reevaluate your risk profile, they can call it in immediately.
Right.
And this sudden need for cash, a liquidity shock, can destabilize a company that's otherwise perfectly profitable. That's a huge strategic point you have to get for the exam. And that's a perfect link to payables. When we look at payables as a financing tool, that delay in payment, that sort of borrowing from your supplier, it often involves a very clear trade-off. The financial manager has to weigh the benefit of holding on to that cash for a few more weeks and therefore avoiding overdraft interest against the cost of giving up a valuable settlement discount from the supplier.
So it's a pure cost-benefit analysis.
It's a pure cost-benefit analysis, and it's one the examiner loves because it forces you to convert what looks like a simple percentage discount into its true annual economic cost. The decision isn't just about cash today. It's about choosing the cheapest source of short-term finance available to you. Is it the bank's overdraft, or is it the implicit cost of missing out on that supplier discount?
And if you get this management wrong, the ultimate failure leads to a situation that I think a lot of students find quite counterintuitive. It's the danger of overtrading.
Yes. Overtrading, or you might see it called undercapitalization. It's the textbook definition of a cash crisis that's disguised as success. It happens when a company's sales are just exploding. It's growing too fast. But the working capital it has available is just far too low to support that level of growth.
So the profit and loss statement looks amazing.
It looks fantastic. Sales are through the roof, margins are healthy, but the company could be facing a really severe, potentially fatal liquidity problem. The profit is real, but the cash needed to fund all those sales is permanently stuck. It's tied up in ever-growing piles of receivables and inventory. Every new sale is a new invoice you won't get paid for 60 days, and it's new stock you had to buy. The company is literally running out of cash because it's so successful.
That's such a vivid picture, a company just drowning in its own success.
Hmm.
So if a company's overtrading, what's the actual structural solution?
And that is the critical distinction the examiner is looking for. The structural solution to overtrading is not just to squeeze your working capital cycle harder.
So you can't just demand customers pay in 10 days instead of 30.
You can try, but that's just a temporary fix, and it often really damages your commercial relationships. The real long-term solution is that the company has to raise additional long-term finance. If the business is fundamentally profitable, like the P&L says it is, it should be able to attract that capital. Maybe it's new equity, maybe it's a long-term loan. The problem is a structural mismatch. The long-term investment needed for high growth is being funded by high-risk, short-term tools. And that's a recipe for disaster. Working capital policy cannot solve a capital structure problem.
Okay, so before we can recommend that long-term finance, we need the diagnosis first. And that brings us to the key liquidity ratios. These are your early warning system. We look at two main ones, and you need to understand what they really mean, not just the formulas. First up is the current ratio. That's your current assets divided by your current liabilities. Broadly, it's asking, does the business have enough short-term assets that will turn into cash, like receivables, to cover its short-term debts, like payables?
And the general rule of thumb is,
We usually expect it to be greater than 1. If you see a ratio well below 1, say 0.8 to 1, that's a flashing red light. It strongly suggests there are immediate liquidity problems. But, and this is important, context matters. A ratio that's too high, maybe 4 to 1, might actually signal inefficiency. It could be too much idle cash or bloated inventory. The goal is efficiency, not just a big number.
and that point on inefficiency leads us perfectly to the second ratio, the quick ratio, or as it's also known, the acid test. It's a similar idea, but it recognizes that not all current assets are created equal. They're not all equally liquid.
Right, so what does it strip out?
The quick ratio excludes inventory. Why? Because inventory almost always takes the longest time to turn into cash. And crucially, it often needs more money spent on it. Selling costs, finishing costs for work in progress, before you can even sell it. Receivables, on the other hand, well, the goods are already sold. It's just cash waiting to be collected.
So the much stricter test of immediate liquidity.
A much truer, faster picture. Now, here's a key exam point. While we like to see the current ratio above 1, a quick ratio that's a little bit less than 1 isn't automatically a disaster. It really depends on the business. A supermarket chain, for example, they turn over their inventory in days, so they can operate very safely with a low quick ratio because their inventory is almost as good as cash. But say, a bespoke engineering firm with huge long-term projects, they might need a much higher quick ratio because their non-cash assets, their work in progress, are highly illiquid. Context is everything when you're interpreting these ratios.
Okay, that's the strategic backdrop. Let's pivot now and focus entirely on receivables management. This is really the art of controlling the money your customers owe you. And it all starts with why you grant credit in the first place.
That's the foundational question. You have to remember, credit is a commercial tool. It's not just an admin task. And there's this inescapable fundamental trade-off. On the one hand, offering credit makes sales happen. It boosts your revenue, and that drives your profit. In almost any competitive market, you have to offer terms 30, 60, 90 days, or you just won't be in the game.
But the downside is huge.
It's significant, and it has to be managed. Granting credit means your investment in working capital goes up. That cash is effectively being loaned to your customer, interest-free, and at the same time, you're increasing your risk of bad debts. So the financial manager's job is to find that sweet spot between getting the sales and minimizing that investment and risk.
Here's where it gets really interesting for me. We talk about credit terms as if companies just decide them in a boardroom. But really, they're heavily influenced by the market, right? I mean, why do we let customers pay late in the first place?
Well, it's mostly competitive necessity and industry standards, what we call trade custom. If every single one of your competitors offers 60-day terms and you come in demanding cash up front, or even 30 days, you're probably going to lose market share unless your product is totally unique.
So the financial manager doesn't decide this in a vacuum.
Not at all. The policy has to be aligned with the competitive landscape, and that sometimes means you have to accept a credit period that's, less than financially optimal just to keep the revenue stable.
Okay, so if we have to grant credit, then control becomes everything. And the exam expects you to be able to lay out the pillars of a really robust credit control policy.
Absolutely. Due diligence before a big sale is completely non-negotiable. For a new customer, you should be using credit rating agencies, like Dun& and Bradstreet, to get an independent view of their financial health. You should also be asking for trade and bank references. You want to know how they've paid other suppliers. Is their track record good?
And what about for really big customers? Say one customer who's going to be 30% of your annual turnover.
For them, you have to go deeper. A diligent financial manager must assess their full financial statements. That means you're calculating their liquidity ratios, checking their debt levels, looking for any warning signs.
And this isn't a one-time thing, is it?
Oh, not at all. Control has to be dynamic. You need to constantly analyze the payment record of existing customers. If someone who always paid in 30 days starts slipping to 45, then 50, that's a red flag. That's a sign of strain in their business, and you need to act before they become a bad debt.
And finally, that means you have to constantly review credit limits. These limits are your maximum exposure. They need to be adjusted up or down based on performance and, well, the general health of the economy. This whole ongoing process is what the examiner sees as good governance.
Okay, let's connect this idea of control to a key quantitative tool. The settlement discount trade-off. This is prime exam territory. It's all about converting a simple percentage into a true economic rate. The question is always the same. Does the benefit of getting your cash in quicker outweigh the financial cost of the discount you're giving away? If a customer pays 60 days sooner, that's cash you can use to pay down your overdraft. That's the benefit.
And the cost is the discount itself. Now, the common mistake here, and this is where you show your thinking at an examiner's level, is just looking at that nominal discount, a 1% discount. The examiner wants you to calculate the implied annual cost of not taking that discount. Let's use a typical scenario. You offer a 1% discount for payment in 30 days. Standard term is 90 days. So the customer who ignores that discount is effectively borrowing that money from you for an extra 60 days.
Exactly. That 1% is the interest they are paying you for a 60-day loan. So to really understand the cost, we have to annualize that rate. If you're getting 1% every 60 days, you ask yourself, how many 60-day periods are there in a year? 365 divided by 60. It's about 6, so that 1% is happening 6 times a year. When you compound that, the effective annual rate is much, much higher than 6%.
It skyrockets.
It really does. And so if your calculation shows that offering this discount has a significant net cost, like the hypothetical $46,000 negative impact from the source material, then the clear advice is do not offer it. It shows that even though your cash flow might speed up, the effective interest rate you're offering is way higher than what you're paying the bank on your overdraft. Faster cash is not always worth the price, and you have to prove it with that comparison.
Moving on from discounts, another way to accelerate cash flow, and often offload risk, is by factoring receivables. This is a huge area for FM students. You need to understand the different service tiers. So factoring is basically paying another company, the factor, to manage your receivables ledger for you. And the cost, the factor's fee, is usually a percentage of your sales turnover.
And they offer a tiered service. The most basic level is just administration. For a small fee, the factor takes over the admin burden. They run the sales ledger, send out statements, chase debts.
So you save on internal staff costs.
You save on staff costs, you free up management time, but, and this is key, your company still carries all the risk of bad debts.
Okay, so what's the next level up?
The next tier, and the one that's most attractive if you have a liquidity problem, is advanced money. Here, for a higher fee, the factor gives you an immediate cash advance. It's often 80% or so of the invoice value right when you issue it. This is a massive instant boost to your liquidity.
And the top tier?
The top and most expensive tier is non-recourse factoring. This is basically where you buy credit insurance from the factor. The factor takes on the responsibility for any bad debts. The credit risk is transferred from you to them.
And you have to contrast that with recourse factoring.
Exactly, where your company keeps the bad debt risk, even if the factor is doing all the admin.
Okay, but let me challenge that a little bit, because this is something an examiner might expect you to think about. If a factor is taking on all the risk in a non-recourse deal, doesn't that make them, well, incredibly aggressive when it comes to collecting the debt? Couldn't using a non-recourse factor actually damage your relationships with your own customers?
That is a brilliant point, and that is absolutely part of the commercial judgment that gets you the high marks. A factor is focused on one thing, getting the cash in fast. That aggressive style can absolutely destroy customer goodwill. So the FM has to ask, does the factors collection style fit our company's culture? If you sell high-value relationship-based products, aggressive factoring could be a disaster, even if the math looks good on paper.
But the math still have to be done.
Oh, yes. The decision has to be quantified. It's a classic cost-benefit analysis. On the cost side, you've got the factors fee. And on the benefit side, you have to value each component. First, the staff savings from not having your own credit control department. Second, and this is often the biggest number, the interest savings.
Because you're getting cash in faster and reducing your overdraft.
Exactly. You calculate the reduction in your average receivables balance and multiply that by your overdraft interest rate. And third, with non-recourse, you add in the value of the bad debts you no longer have to suffer. The decision then comes down to, do the total benefits outweigh the factors fees? Even a small net benefit, say $15,000 a year, is a pure gain. It justifies using the factor. But the key takeaway for you is that the interest saving calculation is usually the trickiest and most important part to get right.
Okay, let's completely flip this now and look at payables management. It requires the same strategic brain, but with the opposite objective. We're now in what you could call the payables paradox. From your company's point of view, your payables are a form of free finance. It's an interest-free loan from your suppliers.
So the business objective is pretty straightforward.
You want to maximize this free finance. You delay payment for as long as you possibly can, right up until the point where delaying starts to cost you something. The trick, of course, is doing this without damaging those vital supplier relationships that your whole business depends on. You want to stretch the float, but not break the chain.
And to measure that, we need to know exactly when that finance stops being free. It's only free up to the point where the cost of delaying is more than the benefit of keeping the cash.
And what's our benchmark for that benefit?
It always comes back to the company's overdraft interest rate. That is your cost of borrowing short-term cash. If delaying payment for another month saves you from borrowing $100,000 from the bank at 13%, then that delay is a good financial move. You're using a 0% loan from a supplier instead of a 13% loan from the bank.
Which brings us right back to the other side of the coin. The critical payables discount trade-off. This is probably the most common calculation in the entire working capital syllabus.
It really is.
Let's take the scenario. A supplier offers you a 1.5% discount if you pay in 15 days instead of the standard 40 days. If you choose to pay early, you get that 1.5% benefit. But you give up the use of that cash for the difference in time.
Which is 25 days, 40 minus 50.
Exactly, 25 days. So the calculation logic is to work out the effective annual interest rate that you're essentially earning by paying early. By grabbing that 1.5% discount, you're getting a return on your cash over that 25-day period.
And we have to annualize that return to see if it's a good deal compared to our cost of borrowing. This is where the examiner expects flawless commercial logic. Using the kind of numbers you'll see in your study materials, that 1.5% discount over 25 days, the effective annual cost of delaying payment, the rate you're implicitly paying your supplier for that 25-day loan works out to a staggering 24.69%.
Wow. Okay. So you compare that 24.69% to your overdraft rate.
You compare it to your overdraft rate, which might only be 13%. So the conclusion you write for the examiner has to be clear and logical. Take the discount.
And the reason is?
The reason is that the opportunity cost of missing that discount at 24.69% is almost double the cost of just borrowing the money from the bank at 13%. It makes absolute financial sense to borrow cheaply at 13% to capture a massive saving of 24.69%. This deep comparative analysis, that is the essence of high-scoring FM work.
We've spent a lot of time on the numbers quantifying these decisions, but as you said right at the start, for the ACCA FM paper, the calculation is just the input. The commercial judgment is the real output.
Exactly. The examiner's expectation goes way beyond just the arithmetic. You have to show you have commercial acumen. Just writing option A is cheaper isn't enough. You have to discuss the qualitative, strategic elements of the decision. That discussion of the trade-offs is where the top marks are found.
That's the difference between being an accountant and a financial manager.
Yeah.
So let's talk about those judgmental aspects, starting with receivables. So your calculation shows that tightening your credit terms will save you a lot in interest. The qualitative follow-up in your answer has to be, okay, but what's the impact on sales volumes and our market share?
Right. If all your competitors are still offering 60 days and you suddenly demand 30, your sales might just fall off a cliff.
Yeah.
And that could wipe out any financial savings you calculated. You have to weigh the risk of losing customers against the internal financial gain.
What about the quality of customers?
That's another great point. If you offer a really generous discount for early payment, do you just end up attracting cash-strapped, poor-quality customers? They might take the discount but still pay late or even default later on, so your risk profile actually gets worse.
And this qualitative balance is just as important for payables. If the numbers say you should delay paying your suppliers to the very last second, you have to then discuss the main trade-off.
Which is, will this severely damage my relationship with a key supplier? This is a high-level strategic point because it links to other concepts like just-in-time inventory.
So if you rely on that supplier for rapid, high-quality deliveries,
Mhm.
then annoying them by always paying late could be a disaster. They might start prioritizing other clients, your supply chain could be jeopardized, quality might drop. That little bit of interest you save by paying late is nothing compared to the cost of shutting down your production line because a critical supplier has cut you off. Your written answer absolutely must explore these real-world business risks. Okay, let's talk about common mistakes. Knowing where other students trip up is so useful. There's one big quantitative error and one big qualitative one. The main quantitative mistake, and we've hammered this point, is the misinterpretation of discounts. Students just treat a 1.5% discount as a simple saving. The examiner is looking for you to see it as an opportunity cost calculation.
You have to annualize that rate and compare it to the company's cost of short-term finance, which is almost always the overdraft rate. If you don't do that comparison, you've missed the entire commercial point.
And the qualitative failure.
The big one is ignoring the enforcement of credit terms. It's so easy to write in your answer, the new policy is 30 days. But setting terms is useless if you don't enforce them. Customers will always try to take the discount even if they pay late. They'll always try to stretch the 30 days to 40. So the policy has to be printed on the invoice, and it has to be backed up by a rigorous, consistent collection process. Without enforcement, the policy is just words on a page.
So to pull this all together, let's give everyone 3 clear exam-ready takeaways that really define that examiner-level thinking.
Okay, number 1, context is king. In your answer, always state that the goal of R&P management is to minimize the investment in working capital while maintaining sales and supply continuity. It's about efficiency without damaging the business. Number 2, focus on cash flow. Your whole analysis should emphasize that these are all fundamentally cash flow decisions. The benefit of a discount, the cost of a factor, it's all measured by its impact on the timing and speed of cash, not just its effect on the P&L. And number 3, use the risk-return principle as your framework. Every single decision we've talked about has a trade-off. You have to show both sides. The quantifiable return, the savings versus the inherent risk, the bad debts, the supplier anger. A top-tier answer acknowledges that tension and applies judgment.
So what does this all mean? I think what we've established today is that mastering receivables and payables management, it isn't about memorizing formulas. It's a really dynamic, high-stakes exercise in financial engineering. It directly influences profitability, liquidity, and overall business risk. If you can measure the logic of these trade-offs, if you can really understand the power in every invoice you send and every invoice you receive, you will have mastered a core, high-scoring part of financial management.
And here's a final thought for you to take away as you finish your preparation. We focus a lot on R&P in isolation, but you have to remember the interconnectedness of the entire working capital cycle. So let's say you implement a new super strict policy. You aggressively cut your receivables collection period. That's great. It generates cash quickly. But that action often requires you to then have much tighter control over your inventory and your internal cash flows. Why? Because if you're not careful, you can create a self-imposed liquidity squeeze somewhere else. If you demand cash faster from your customers, you have to be sure your own processes for managing stock and making new sales are just as efficient. If not, you've just shifted the crisis from receivables over to inventory. Effective working capital management is a truly holistic effort.
That is fantastic practical context to take forward into your exam. If you found this deep dive valuable and you want to continue building that examiner level knowledge for your ACCA exams, we invite you to connect with SmartPass. We're here to help you move from just knowing the formulas to really mastering the application. You can subscribe to the SmartPass YouTube channel for more ACCA prep guidance at https://www.youtube.com/SmartPass You can also follow SmartPass on Instagram for daily ACCA exam tips. That's at https://www.instagram.com/pika.smart.pass. And you can access premium ACCA FM study kits and comprehensive exam strategies on Gumroad at https://atps.gumroad.com. We wish you tremendous success in your upcoming FM exam. We'll talk to you next time on The Deep Dive.